I'm Grant Mundell, Investment Specialist with Equity Trustees, with our October market review. Global equities rose 2.2%, with emerging markets outperforming developed markets, and the ASX 200 lagging, only rising 0.4%. The artificial intelligence theme continued to bolster stocks, with the Magnificent Seven jumping 4.9%, and the outlook for artificial intelligence hyperscalers remaining strong. Those hyperscalers reported strong cloud-related revenues and CapEx plans during reporting season. CapEx plans remain buoyant given apparent capacity constraints, and the chart on the top right shows the ever-increasing level of investment. However, investors are asking more questions about the circular nature of much of the AI investment and the potential returns on the huge investment being made. The Japanese market soared, boosted by the new Prime Minister, who announced a range of measures to counter inflation, accelerate defence spending and bolster growth. The Australian share market lagged due to a higher inflation number that led investors to reduce the number of rate cuts they expected, but the resources sector was a key outperformer, and that was driven by higher prices in a wide range of commodities. The chart on the bottom right shows that the RBA has now revised up their inflation forecasts. The US reporting season was solid, with about 80% of companies beating expectations, and the average earnings beat's been around 8%. Year-on-year earnings growth is around 11.5%, and that's being driven by big tech companies, which are up around 30% year-on-year in terms of earnings growth. In the global macro environment, US-China trade talks ended quite favourably. The US Fed cut rates by 25 basis points to 3.75 to 4%, but didn't commit to more rate cuts this year. The US dollar was stronger against most major currencies, up around 2%. That's only the second monthly gain this year. And the US government shutdown did continue and move towards the longest shutdown in history. The China Plenum, or the 15th five-year plan, indicated a shift towards domestic demand and consumption, and proactive fiscal policy, market reforms, along with technology self-sufficiency and innovation. In Australia, 75 basis points worth of rate cuts that we've seen already this year has helped the consumer and the housing market. However, given the latest inflation data, it appears the RBA might only cut on one more occasion. What that's meant is that investment returns over the course of the last 12 months have been very strong. This chart shows a range of different asset classes and how much they've increased. And you can see on the very left, gold has outperformed very strongly. Equity markets around the globe have done very well. The ASX 200 is up over 10%, but has lagged all of those global equity markets. And even defensive asset classes such as bonds have done well as well. And the reason for this is due to the resilient global economic data that we've seen, the rate cuts that we've seen from a range of central banks, increased fiscal spending around the globe, continued earnings strength in the information technology sector and the CapEx plans from the big hyperscalers, etc., and improved corporate governance in Asia, which is helping markets such as Japan. From an earnings perspective, we'd highlight that notably the ASX 200 consensus earnings were actually revised 3% higher in the month of October, and that was driven by upgrades to the materials or resources sector. And these upgrades flowed through due to high commodity price forecasts coming through. That's notable because for the last pretty much 2 years, earnings have been consistently revised down. Globally, in October, earnings expectations for global equity markets rose 1.7%, driven by upgrades to emerging markets, which saw their earnings revised up 4.6%. The chart on the bottom left shows that this year, 12-month forward earnings have experienced positive revisions in many global markets. The ASX 200 has lagged, but recent upward revisions are obviously helpful. What this has meant is that earnings growth across a range of markets is forecast to be very strong in 2026, which, if maintained, should be supportive for equity markets. Higher earnings should also support dividend growth as well. The ASX 200 dividend yield is currently at very low levels versus history, and that's shown on the bottom left-hand side. And that's due to the fact that we've seen 3 years worth of declining dividends, and that is primarily due to the resources sector, which have cut back on their dividends due to lower earnings. It's also been because of lower payout ratios in the industrial sector, and obviously a higher market price, which has meant the yield has been depressed. The dividend yield for the ASX still compares well to international markets, and growth in underlying dividends will be welcomed by many income-seeking investors. However, a key concern with equity markets is their valuation. In aggregate, at a global and local level, they look expensive. However, there are pockets of value within certain equity markets and within certain sectors. The chart on the bottom right shows the ASX 200, and you can see the price earnings multiple is elevated there versus history. And on the left, you can see that the darker line being the US market is quite high. However, the light blue line, which is developed markets excluding the US, and the yellow line, which is emerging markets, show more value. We'd highlight that there are certain sectors that also show good value as well. And what this means is we think an active approach is a good one within equities at the moment, as well as increasing diversification across a range of different asset classes within investor portfolios. I'll be back again next month with our market review.